Good morning everyone. Hello, good morning everyone. Good morning Jyotish, good morning Nimisha, good morning Mansi, good morning Vivek, Harshada, Mitali, Hardik, Kirti, Pankaj. Good morning everyone and welcome to this session of the direct taxation, and yes, one of the most critical topics, one of the most critical chapters of your syllabus, which is capital gains. So PGBP and capital gains are not only lengthy but also critical. So yes, welcome to the second session. This is the second session of our chapter of capital gains. Welcome to this session. And in this particular session, we are going to deep dive into certain peculiar cases where capital gain computation is a little different from the usual computation. So guys, in the earlier class, we had studied the usual computation which is there for long-term and short-term capital gain. So in long-term capital gain, we usually reduce the index cost of acquisition from sales consideration to get our capital gain. Similarly, in short-term capital gain, we usually reduce the cost of acquisition from the sales consideration to get the capital gain. So guys, this is the usual trend which we follow while computing the capital gain. However, in certain circumstances, in certain situations, the computation is a little different. And in this particular session, we are going to deal with a lot of such situations, a lot of such peculiar cases where the computation of capital gain is a little different from the usual capital gain. Yes, how are you doing? Hello guys, how are you doing? Good morning. And yes guys, test of capital gain will be held this weekend. This weekend the test is there. So test will be there till the chapter which we finished today, till the topic which we finished today. And withdrawal of exemptions will not be asked in your test. Test will be held on Sunday. Test will be held on Sunday. Yes, sir. Sunday, 7 p.m. Capital gain test will be held in two parts, right? Part 1 and part 2. Both the parts will be separate, and first part will contain the first half of the chapter. Second part will contain the second half of the chapter. That is how we are going to do the test of capital gains as well. Yes, sir. Test of capital gains. All right. Yes. Now we are going to a chapter of capital gains and some peculiar calculations. That is what we are going to start now. Good morning, Abhishek. Good morning, Tanupriya. Good morning, Satyathia Paul. Good morning, Avni Pandey. Good morning, Anjana. Good morning, Janmeja. Good morning, everyone. All right. So in this particular session, guys, we are going to compute capital gain of certain peculiar cases. So the case which we are going to start with right now is the case where capital asset is transferred from a partner or a member to the firm or AOP or BOI. Now, this is a very peculiar case where a partner of a firm transfers his asset to partnership firm. Okay, so why would a partner transfer his assets to partnership firm? Guys, sometimes the partner does not have money to contribute to the business of his partnership firm. In that situation, the instead of money, the contribution, capital contribution is done in terms of capital asset. So capital asset is transferred from a partner to the partnership firm. This transfer of capital asset from a partner to a partnership firm is definitely categorized as a transfer because it is a transfer in hands of the partner. So partner is is transferring his asset from his kitty to partnership firm's kitty. Therefore, it will be taxable in hands of the partner. Yes, sir. So let me just open another slide deck for all of you. So this slide deck will be a little slow because it contains a lot of slide. I have another slide deck which contains only slides which we need to discuss today. All right. So we were discussing that a partner may transfer his capital asset to the partnership firm. And while the partner transfers his capital asset to the partnership firm, this is termed as transfer in hands of the partner. Partner is actually transferring his asset from his kitty to partnership firm. Now the question is that partner is not getting anything in return. I mean, he is getting something in return, but not in consideration form, not in money form. He's getting something in return, and the thing which he's getting is his equity in the capital of the partnership firm. He's getting something in return, which is his equity. He's getting his share of equity in the partnership firm. Now the question is, in absence of a sales consideration, how will we compute the capital gains in hands of the partner? At the end of the day, the partner is transferring his asset to the partnership firm. When the partner is transferring his asset to the partnership firm, guys, in that situation, we need to ascertain how the capital gain will be computed. And the capital gain, for computation of capital gain, we need sales consideration. There is no sales consideration in this particular case. Unfortunately, there's no sales consideration. So yes, to solve this problem, we have this section which will talk about how the computation of capital gain will happen in case the assets are transferred from a partner to the partnership firm. How would the sales consideration be calculated? All right, so let us come back to the slide, guys. Yes, and this is my slide. There is some problem in opening the slide deck. Let me try another slide deck. Some problem in opening the slide deck, guys. All right, yes. We are just opening the slide, and the question which we need an answer for is that what is the sales consideration when a partner transfers his assets to the partnership firm free of cost? I mean, it's not free of cost. Actually, equity of partnership firm is being given to the partner, but in a sense, that particular transaction will not entail any receipt of money. Money is not received. In case money is not received, the law is very clear, guys. The law is that sales consideration should be equal to the value of the asset which is booked in the books of accounts of the assessee. So whatever is the value of asset which is booked in the books of accounts of the partnership firm, because partnership firm is taking the capital asset from the partner. So according to accounting norms, according to the accounting principle, the partnership would also add something in its books of accounts. So whatever amount the partnership firm has added in his books of accounts, that amount will be the sales consideration in hands of the partner of the partnership firm. That is the principle which we are going to study now. So sales consideration is sorted. Sales consideration is the amount of book value of that asset which is introduced in the books of accounts of the partnership firm. So at whatever value partnership firm is undertaking that particular asset, that value will be the value of sales consideration in hands of the partner. That is the sales consideration. So what will be the cost of acquisition? Guys, cost of acquisition will be, as usual, the cost which the partner has paid while he had purchased the asset earlier. That will be the usual cost of acquisition. So how would the indexation benefit be given? In very, very usual manner, in the normal manner, indexation benefit will be given CII of the year when this asset is transferred divided by the CII of the year when the asset was purchased. So during this methodology, we are going to compute the indexation. So indexation will be computed in the usual manner. There's no difference in computing the cost of acquisition. Okay, some technical glitch. Let me close the program. I think we need to refresh the page and start again. All right, so we are going to start the slide deck again. Yes, that's the slide deck for capital gains, and it's still opening. नीरज चौधरी, अगर तुम्हें इस सवाल का जवाब अब भी नहीं पता तो तुम एलिजिबल ही नहीं हो एग्जाम देने के, तुम एग्जाम दो ही मत। नीरज चौधरी हमसे पूछ रहे हैं, सर एग्जाम ऑनलाइन होगा या ऑफलाइन, प्लीज बताओ। अगर इस सवाल का जवाब आप में से किसी स्टूडेंट को अभी भी नहीं पता तो आप शायद एग्जाम दे ही नहीं पाओगे, तो आप छोड़ो, अगले अटेम्प्ट में एग्जाम देना। ऑब्वियसली, मतलब ये तो ऑब्वियस है, इट्स ऑल ऑनलाइन, नथिंग इज ऑफलाइन। ऑल राइट, थोड़ा सा टाइम लग रहा है ओपन होने में, लेट्स सी। And let me repeat, guys, test this Sunday for first half of capital gains. First half capital gains ka we'll have test, and that test will be conducted online 7 p.m. Zoom meeting ke through test conduct hoga, and we'll meet on Zoom meeting, and then we'll conduct the online test this Sunday 7 p.m. And every Sunday 7 p.m. we have test of direct taxation. So you guys are advised to meet me on the Zoom call every Sunday for the test of direct taxation. That is very, very essential. Okay, sir. So yes, that's the slide deck for capital gains, and we have covered this portion in the last class, guys. So we are directly jumping on to the portion which we need to do today. Okay, guys, just give me 2 minutes. Just give me 2 minutes. I'm closing my camera. Let me sort out this technical glitch. Just be online. Don't go offline. Just give me 2 minutes. All right, the problem is solved now, right? So let's see if the partner transfers a capital asset to a partnership firm. What will be the tax implication? How will the capital gain be computed? Now, I have already told you guys that in this particular situation, we don't have sales consideration. So sales consideration as per law is the amount recorded in the books of accounts of the partnership firm or AOP BOI. So whatever amount is recorded in the books of accounts of AOP BOI or partnership firm, that amount will be deemed to be the sales consideration for the partner. Partner, we'll assume that partner has transferred his asset on this particular sales consideration. Then, guys, indexation benefit as well as cost of acquisition or improvement will be as usual. There is no difference. We had studied in our last lecture. Whatever principles are there, they remain as usual. Now, one very important point to be noted over here, an examiner is definitely going to confuse you on this particular point. Fair market value of the asset as on the date of transfer is irrelevant. So whatever is the fair market value of that asset as on the date of transfer is irrelevant. It is absolutely of no consequence what is the fair market value of the asset as on date of transfer. And trust me, examiner is definitely going to give you this information just to confuse you. So in case a partner transfer his assets to partnership firm, then the sales consideration is always the amount recorded in the books of accounts of the partnership firm. That is the way the sales consideration is recorded. Examiner is definitely going to give you the FMV. Please ignore the FMV in this particular case. All right. So guys, just like a partner can transfer his assets to the partnership firm, similarly, a partnership firm can also transfer its asset to the members. A partnership firm can also transfer the assets to the firm AOP BOI. Now, if the transfer is made, transfer of capital assets or money is made by firm AOP BOI to its partners on dissolution or reconstitution, then we have certain special sections to deal with it. And guys, please write very important with this particular section, because this section has been recently introduced in the act, and therefore its probability of coming in the examination is much higher than any other section. Especially for CMA final students, I would definitely expect the examiner to give a particular a very small question from this particular concept in your forthcoming examination, be it June 22 or December 22. For intermediate student, theoretically this particular section is important, but practically it might be a little less important, right? But for final students, theoretically as well as practically, this section will be very important, because it has been recently introduced in the act. Now, the question is, transfer of capital assets or money by a firm to its partner member on dissolution or reconstitution. So if a membership firm, if a partnership firm is getting reconstituted, or it is getting dissolved, it is getting it is getting ended, then in that case this particular section will apply. Now, two words are there in the heading. Please note the two word. First is dissolution, second is reconstitution. Dissolution means when the partnership firm comes to an end, when all the partners decide to end this partnership firm, then it is known as dissolution. Reconstitution means that, there is some change in the constitution of the partnership firm. For example, one of the partner retires, another partner gets in, or a change in profit sharing ratio, or one of the partners dies, another partners take over his share or give his shares to the legal heir, etc. So reconstitution means when the firm is getting changed, when the structure of the firm is getting changed in terms of partners, in terms of profit sharing ratio, etc. That is known as reconstitution. So two words, dissolution and reconstitution. We are going to see the treatment separately of dissolution and reconstitution. Two different treatments are there, one for dissolution, another one for reconstitution. Now, guys, the simple fundamental is that when a firm is getting dissolved, when a firm is getting ended, when a firm is getting end of its useful life, at that point in time, the assets of the firm can be a very useful way of repaying the capital of the partners. And the only recourse that the firm has, because the firm doesn't have anything else to repay to the partners, the only recourse which firm has is that it can pay off its partners' capital in form of money, in form of capital, in form of assets, capital assets, which are there in the partnership firm. So in case of dissolution, capital gain on transfer of capital assets. Now, in this particular case, guys, capital assets are being transferred from the partnership firm to the partners. So in a way, it is a transfer of capital assets. Okay. So capital gain will be recorded, of assets will be recorded on the transfer of the capital assets to the partnership firm, to the partner from the partnership firm. In this case, the capital gain will be computed using this formula, and the formula is fair market value of the capital asset. So the day when the firm is getting dissolved and all the partners are getting their assets, share in the assets, at that date, what is the fair market value of the capital asset which is being distributed to the partners? That is the sales consideration minus what is the cost of acquisition of that particular asset in hands of the partnership firm. In hands of the partnership firm, what is the cost of acquisition? So this is the formula which we are going to use in case we need to compute the capital gain in case of dissolution of a partnership firm. Now, in case of reconstitution, there's a slight difference in case of reconstitution. What happens in case of reconstitution? So guys, reconstitution, we can divide the capital gain computation into two parts. Number one, when capital gain is computed on transfer of capital assets, okay, when only capital assets are being transferred. And second is when capital gain is computed on transfer of capital assets as well as money. So there are two sections which deal with reconstitution. So in case of dissolution, there's only one section which deals with dissolution. But in case of reconstitution, the capital gain is computed under two sections. First section is section 9b. Second section is section 45(4). So there are two sections under which capital gain is computed in case of reconstitution. Sir, does it mean that on same transaction of reconstitution, we have to pay capital gain twice? Does it mean that? Guys, you might feel that the capital gain is being paid twice on a particular transaction, but mind you, One very, very important thing, that the capital gain which you pay under section 45(4), which is on capital gain on transfer of capital assets or money, that is eligible for a credit under section 48. So that particular amount is eligible for a credit under section 48. So there is no double taxation. So capital gain is not levied twice, because this capital gain will be eligible for a set off, for a credit under section 48. So there is no double taxation which is happening. But yes, guys, prima facie, let us read the section, what the section says. The section says that in case of reconstitution, right, capital gain is first computed under section 9B. What is the formula? Formula is absolutely the same. Fair market value of capital asset minus cost of acquisition of the capital asset. So fair market value of the capital asset, fair market value on the date when this reconstitution is happening, and the asset is being transferred from the partnership firm to the partner on that particular date. What is the fair market value of the capital asset? That is the baseline, and minus cost of acquisition of that particular asset. What is the cost at which that particular asset was acquired? That is reduced. This will give us capital gain on transfer of capital assets. Guys, same transaction will be taxed in another section 45(4). According to this particular section, the capital gain will be computed on transfer of capital asset as well as money. So guys, if money consideration was there, then this particular section did not talk about that. So money first time will be taxed only at this point in time. Money was not a relevant criteria. If along with the capital asset, some money is also being transferred to the partner, then it was not taken into account under this particular section. But in this section, the capital gain will be computed using two things. Number one, the capital asset as well as money which is being transferred from the partnership firm to the partner. Now, what is the formula? Formula is fair market value of the capital asset, which is actually the same as the sales consideration which was considered over here, right? It is the same. Fair market value of the capital asset plus value of money. So whatever money is being transferred to the partner, that is also being added as the sales consideration. That is also being added as the sales consideration. So we are adding both the things, fair market value of capital assets plus value of money which is being transferred to the partner, minus, guys. Now, after minus, what is the thing? The thing is partner's capital account. Whatever capital was outstanding in hands of the partner when he is retiring, at that point in time, whatever is the capital account is being reduced from whatever value he is being given. So let me tell you, this view, this particular section, or this particular category of computation is strictly focusing only and only on the value of capital asset. Let me repeat. This part of the section is focusing exclusively on the capital asset part of the transaction. Whatever capital asset is being transferred from a partnership firm to the partner, how would that be taxed? How would capital gain in that particular scenario be computed? So this particular part of capital gain computation, 9B is focusing on what? It is focusing on the capital asset that is being transferred to the partner of the partnership firm. What capital gain will accrue on that capital asset? It is focusing only and only on capital asset. However, this part 45(4) is actually focusing on what additional benefits apart from the capital account of the partner is being given to the partner. I'll give you an example, guys. I'll give you an example. Okay, partner Mr. A, Mr. B, Mr. C, three partners of a partnership firm. Mr. A has a capital account balance of 3 lakh rupees. Mr. A has a capital account balance of 3 lakh rupees. Mr. A, in place of his capital account, because he's retiring now, for recouping his capital account, we are paying, please note, we are paying two things to Mr. A. Number one, capital asset worth 2 lakh rupees and cash worth 2 lakh rupees. We are paying two things to Mr. A. Number one, capital asset worth 2 lakh rupees, cash worth 2 lakh rupees. Now the question is, why? Why is Mr. A being paid over and above his capital? His capital was 3 lakh rupees. Why is he being paid over and above 1 lakh rupees over and above his capital? This is extra payment of money more than his capital. Sir, would it represent the profits which have been accrued in his account in past profits, whatever has been accrued, or any accretion which has been accrued in the partnership firm? Does it represent that? Guys, whatever it represents, Income Tax Act says that it is capital gains in hands of Mr. A. It is capital gains in hands of Mr. A. If Mr. A is paid anything over and above his capital account, that will also be counted as capital gains in hands of Mr. A. So this is a myopic vision, which is only concentrating on the capital asset which is being transferred to Mr. A, capital gain which is arising from the capital asset which is transferred to Mr. A. This is focusing on that particular aspect, and this is focusing on the capital gain which accrues to Mr. A on account of excess payment over and above the partner's capital account which is being paid to the partners. Now that income should also be taxed somewhere at least. Capital gain is being levied on that particular income. So guys, let me tell you, this section was there existingly in the past as well, but this part of the section is newly introduced. This part of the section is newly introduced. So earlier section had only this particular part where the capital asset which is being transferred to A was subject to capital gain tax. But the income tax authorities thought that even if partner is getting anything over and above the partner's capital account, guys, then also it deserves capital gain taxation. And therefore, section 45(4) was amended and this part was introduced. Now, the crux of the matter is, sir, same value is being taken over here. 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 So same sales consideration is being taxed twice. Same sales consideration is being taxed twice. Yes, you can say that same sales consideration is being taxed twice. But guys, the catch in this particular question is that this part of capital gain is eligible for a credit in subsequent period under section 48. This part of the capital gain is eligible for credit subsequently under section 48. Therefore, there is no double taxation. Therefore, there is no double taxation. Yes, in the initial year, you have to pay tax twice. In the initial year, you will have to pay tax twice. But in the subsequent year, when you'll get a credit for the payment which is made over here, the capital gain which accrues over here, when you get a credit, then guys, the problem of double taxation is solved. It's resolved. So yes, a very, very detailed section. And yes, guys, in my playlist, please see my playlist on YouTube. In my playlist, I have given amendments of June 2022 and December 2022 attempt. In that amendment also, I've discussed this particular section in detail. Please watch that video also for detailed explanation on this particular section. And as I've told you, especially for CMA final students, this section is going to definitely be important to all of you. Section 45(4) read with section 9B. Yes. Guys, where are you? 45(4) is taxable in hands of firm or partner. Firm, Mitali. We are talking about firm because firm is transferring the capital assets to the partner. Firm is actually transferring. Firm is having the transfer. Therefore, it will be taxable in hands of the firm. Partnership, firm will be held liable to tax. Okay, let's start the next section. Next section is capital gain on transfer by way of compulsory acquisition. All right, let me first of all explain you what do you mean by compulsory acquisition. So guys, compulsory acquisition means acquisition done by law. Compulsory acquisition means acquisition done by law. So whenever law acquires your property by force, whenever law acquires your property by force, that is known as compulsory acquisition. Sir, why would law acquire our property by force? Guys, the reason why law will acquire our property by force is that there is some metro project or some infrastructure project which is planned in the same area where your home is located or where your property is located. Therefore, government wants that property at any cost. Since government wants that property at any cost, therefore, by law, we are going to actually lawmakers will make a law that they will compulsorily acquire this property of yours at whatever price they deem fit. Okay, so government will decide a price for your property. They will give you the property. You cannot say a no. You cannot say a no. Okay. So compulsory acquisition means by law this property is sold to government of India. Now, so the question is, what will be the sales consideration in this particular case, guys? Usual sales consideration, whatever has been received. Okay. And sometimes the sales consideration is received in a piecemeal manner, which means first installment will be received now, second in next year, third in next year. So guys, entire taxability will arise in the first year of receipt. Whenever the first installment is received, then entire capital gain tax will be levied on you on the entire amount. In the year one of the receipt of part of the consideration, you will be eligible for taxation. Next is indexation benefit. You'll get indexation benefit till the year of compulsory acquisition. So we will not give you indexation benefit till the time you receive the compensation. If you receive the compensation little late, we are not going to give you indexation benefit for compensation which is received late. We are going to give you indexation benefit only till the year of compulsory acquisition. So till that year you compulsory acquire your asset, till that year your indexation benefit will be received. Then what will be the cost of acquisition and cost of improvement? It will be as usual. It will be computed like whatever was your cost of acquisition when you had acquired this property before transferring it to government of India. That particular property, that particular year will be the cost of acquisition year. Yes, indexation benefit will be available to you, and whatever other benefits are there, they are usually benefit available to you. This is transfer by way of compulsory acquisition of land. Next. Okay, now we come on to a very, very important section, guys. The section is joint development agreement. The section is joint development agreement. This is a very, very important section. Please understand the concept of joint development agreement first, and then I'm going to deep down into delve into the treatment. Okay, what do you mean by joint development agreement? Okay, now suppose there is a land. This is a land. Okay, this land is owned by four brothers. Four brothers have right to this land, and this land belonged to their father. Before dying, their father had transferred this land to their four brothers, okay, to the four sons, okay. So four brothers have this land kept vacant for them. Now, ideally, all the four brothers should pull in money and develop a home over here. Ideally, all the four brothers should develop a home over here. They should pull in money and they should develop a home over here. But they don't have money. They don't have money to pull in and pull up a home over here. So what they do is they contact a broker. Okay, they contact an external third party who's a broker, who's a real estate agent. They will contact a broker. What will broker agree? What will broker do? Broker will say that, okay, I will employ all the money which is required to build this particular property. I will make 5 floors out of this property. I will put in the necessary material, the necessary cost which is required. I will put in all my resources to make this particular building, to carefully construct this particular building. In return, I just want 1 floor free of cost from all the 4 brothers. So 5 floors will be constructed. 4 floors will be given to each of the brother, and 1 floor will be given to the broker or to the real estate agent who's facilitating this entire construction. This is the deal which happens between the broker or the real estate consultant as well as the brothers. In this particular deal, guys, there can be another situation where apart from taking 1 floor, the broker also takes some nominal amount of money from each of the brothers. So the broker says that, okay, I will take 1 floor from you and I will take 2 lakh rupees each from all the 4 brothers. So in total, I will take 8 lakh rupees in cash, and I will take a floor which is fully constructed floor, and I will sell that floor or I will stay in it. That is my prerogative. I will take that particular floor. I will also take some amount of money. So money is optional whether he takes or not, but floor definitely he is going to take. Now, in this particular transaction, after the home is constructed, so guys, over here you can see the picture where home is constructed. Okay, 4 brothers have joined hands to make the home. So home is constructed. So guys, after the home is constructed, there is an implied transfer in this particular transaction. There is an implied transfer in this particular transaction. The implied transfer is that, guys, all the 4 brothers are transferring a portion of their asset to a third party for a consideration. All the four brothers are transferring a particular premises, a particular area to a third party for a consideration. What is the consideration which is being received by the four brothers? It is the expense which is being borne by that particular broker. Or sometimes what happens is, guys, broker also gives some amount of money to all the three or all the four partners, or all the four brothers. Sometimes broker also gives money. Okay, apart from employing the expenses, broker also gives some money. So in return of the money which is received from the broker, one of the floors is being given to the broker, and the receipt is also categorized by the expenses which is being employed by the broker in constructing this particular property. So this is an implied transfer which is there in this particular transaction, transfer of this particular floor from the brothers to that particular person who is a third party agent. So this is known as joint development agreement. And now we are going to see the computation of capital gain. How would computation of capital gain happen in this particular case? How would capital gain be computed? So guys, capital gain first of all will be computed on the basis of the property which is being transferred to the broker. So what is the stamp duty value of that floor? That floor is constructed, fully constructed. Floor is being given to the broker. The floor is being given to the broker. So the sales consideration of that floor which is being given to the broker is the stamp duty value at the date of issue of completion certificate. So whatever is the stamp duty value of that particular property, that will be the sales consideration which actually is being impliedly received by all the four brothers. So taxability we are ascertaining in hands of the four brothers. What is the taxation? What is the capital gain tax in hands of the four brothers? So the four brothers are having a sales consideration. What are they receiving? They are receiving the stamp duty value. This is an implied consideration. They are receiving the stamp duty value of that particular floor as on the date of issuance of completion certificate of that particular property. So whatever is the stamp duty value of that particular floor, that is the sales consideration in hands of the four brothers. Plus cash, if any. If four brothers are also receiving some cash, apart from the floor is being transferred to that particular broker, broker is also giving some cash. So if they are receiving some cash also, then that is also being added to the sales consideration amount. Now the question is, what will be the cost of acquisition or cost of improvement of that particular property? It will be the proportionate cost which is being incurred to construct that property. It is the proportionate cost which has been incurred to construct that particular property. So guys, property has been constructed equivalent to 5 floors. All the cost will be accumulated. It will be divided by 5. That will be the cost of acquisition or of that particular floor. Again, this amount will also be an amount which is calculated on a pro rata basis, on a proportionate basis. So proportionate cost is the cost of acquisition in hands of the four brothers. Then what is the indexation benefit? Will indexation benefit apply? Yes, indexation benefit will apply till the year of completion of that particular property. So till the year the property is completed, till that particular year, the indexation benefit will be given. Guys, now there can be a situation where property is completed in the year 2017, but the property was transferred to the broker in 2019 because paperwork took time. Sometimes paperwork takes time, right? But in the agreement, the joint development agreement, was very well written that the property will definitely be transferred to the broker, right? So the completion will be the relevant criteria in this case and not the actual transfer. Till the time the property is completed, till that time indexation benefit will be given to the computation. We'll have the indexation benefit till the time the property is actually completed. Till that time the indexation benefit will be given. Okay, sir, got it? And next, what will be the year of taxability? In which year the taxation will be levied? The taxation will be levied in the year when the property is completed, because that is the year in which our property is deemed to be transferred to that particular broker. So year of completion of that particular property will be the year when taxability will arise in this particular situation. So yes, this was joint development agreement and its relevant features for computation of capital gain for all of you. All right, let's move on to the next section. Let's see what is the next section. And the next section is capital gain on distribution of assets. on distribution of assets by a company on its liquidation. So whenever capital assets are being transferred by a company to its shareholders, what will be the tax implication? That is what we are going to determine now. So whatever is the at the time of liquidation, whatever is the capital gain on distribution of assets, that is what we are going to determine now. Now, before I come on to this particular section, guys, let me reiterate the exclusions from transfer. Okay, these are the exclusions from transfer which we had studied in our earlier lecture, in lecture number 1 of capital gains. We had studied these exclusions, guys. And the first exclusion from the definition of capital gain was distribution of assets to the shareholders on liquidation. This is the first exclusion. So if you distribute any capital asset to your shareholder at the time of liquidation, it is free from capital gain tax. It is free from capital gain tax. So suppose a company has a building and that building is being transferred to a group of shareholders who hold a very significant share in that particular company, right? That transfer from the company of this capital asset to the shareholder is tax free. No capital gain will be levied. So then why are we reading a section on this? Guys, we are reading a section on this because some people do it in a different way. What different way, sir? They would first sell the capital asset in the market, and then whatever money is derived, they will then distribute the money amongst the shareholder. So instead of directly transferring the building to the shareholder, they would first sell off the building in open market, and then whatever money is fetched, they will distribute the money amongst the shareholder. This is what they do. And if they do that ways, then guys, capital gain tax will be levied. It is not a transfer of capital asset to the shareholder directly. So in that case, capital gain tax will be levied. And that is why we are reading a separate section for this. But yes, if assets are directly transferred to the shareholders, it is free from tax. No capital gain tax will apply in that particular case. Okay, sir, got it? All right, let's come back to our section. And here is the section. Capital gain on distribution of assets by a company on its liquidation. So if assets are being transferred to the shareholders from the company is transferring the assets on its liquidation to the shareholders, then what will happen? If the assets are transferred directly to the shareholders, then guys, no capital gain will accrue. But yes, we are going to study income from other sources where dividend will definitely accrue. It will be subject to dividend. Okay, we'll study this particular concept in our income from other sources chapter. So dividend taxation will accrue, dividend income from other sources will accrue, but capital gain tax will not accrue if the assets is being transferred to the shareholders directly. So that is the principle. Now comes the complicated situation where, building is huge. Now one building cannot be given to one of the shareholders, and this cannot be done that multiple shareholders are given the building and then they fight over the building amongst each other. That will be a difficult proposition. So the best thing to do is to sell off the building first, gain some money out of it, and then distribute the money amongst the shareholder. This is the best alternative which is available. Okay, so let's see. Assets sold in market and cash distributed to the shareholders. When the assets are sold in market and the cash is distributed amongst the shareholders, then what will be the capital gain implication? So capital gain implication will be arising from on the sale of the asset. Guys, in a usual manner, capital gain tax will levy because the capital asset is being transferred to a third party and not to the shareholders. So the exemption will not apply, right? Because the capital asset is being transferred to a third. So capital gain will be computed as usual on sale of asset. And whatever amount is being distributed to the shareholders, that amount will be charged to dividend, subject to availability of general reserve, free reserves. Okay. So section 222C says that dividend, we will assume cash distribution to the shareholders as dividend only to the extent of reserves which are available in the kitty of the company. So capital gain tax first will levy, and the cash which is being distributed to the shareholders, it will be subject to dividend distribution tax. It will be subject to dividend under section 222C. That is the concept. Okay, sir, got it. So this was capital gain on distribution of assets by a company on its liquidation to the shareholders when it is given to the shareholders. Okay, sir, got it. All right, now comes a very, very important question, section of our syllabus, guys. Capital gain tax in case of amalgamation. Capital gain tax in case of amalgamation, a very, very important topic of our syllabus, a very, very important concept of our syllabus. Please understand what do you mean by amalgamation first. Guys, amalgamation means when two companies join together and they decide to carry on the business together. That is known as amalgamation. In that particular case, assets of one of the companies are being transferred to another company. Assets of one of the company is being transferred to another company. This is the transfer which happens in case of amalgamation. Now, let me reiterate. Let me get you back to the exclusions section which we had read. This is the exclusion section. So guys, in case of amalgamation, also in case of demerger, whatever capital assets are being transferred from the earlier company to the succeeding company, that is exempt from capital gain tax. So if it's a bona fide case where amalgamation is happening for bona fide business reasons and the capital assets is being transferred from the predecessor company to the successor company, then this is exempt from capital gain tax since it's excluded in the definition of capital transfer. It is not considered as transfer. So amalgamation and demerger, both the situation, the assets which are being transferred are not considered as transfer. They are not considered as transfer. So then why are we then why are we reading this section? Because guys, after the transfer is made, there are some other complications which arises. That's why we are reading this particular section. Now let's go one by one on how the capital gain on amalgamation will accrue. Okay, please be with me, be very very vigile. We'll have 10-15 minutes more discussion. Okay, one topic of amalgamation and demerger we'll finish, but this is one of the most important topics, so your 100% attention is required over here. Please don't be distracted from any other distraction. All right, amalgamation means where two companies are joining hands together, right? Now, I've made a diagram to explain you that Mr. A is holding 100 shares of X Limited. X Limited is a company. Mr. A is holding 100 shares of X Limited. Mr. A is holding 100 shares of X Limited. X Limited is a old company, and Mr. A purchased shares of X Limited. You know, many years back, many years back, Mr. X had 100 shares of X Limited. Now, X Limited amalgamated to Y Limited. X Limited amalgamated to Y Limited. When X Limited amalgamated to Y Limited, Mr. A became the shareholder of Y Limited. Mr. A was snatched away for the shares of X Limited. His X Limited shares were snatched away from him and he was given Y Limited's shares. Now, the swap ratio which was decided was that for 100 shares of X Limited, Mr. A will get 50 shares of Y Limited. Sir, why less? Less because, guys, Y Limited shares must be a little more expensive than X Limited shares. That's why X Limited shares must be cheap than Y Limited shares. Therefore, X 100 shares were equivalent to 50 shares of Y Limited. That is the reason why lesser number of shares were given in Y Limited. But that's okay. That's the part of the deal. The scheme which has been devised was devised in this manner as only. So Mr. A was a shareholder of X Limited. X Limited got amalgamated in Y Limited. So Mr. X indirectly became the shareholder of Y Limited. So from 100 shares of X Limited, Mr. A got 50 shares of Y Limited. Now, the transaction is that subsequently, Mr. A sold 50 shares of Y Limited to a third party. Guys, this particular transaction is free from tax. Any transfer of shares during the amalgamation are free from tax. It is included in the exclusion. But, when the shares of the amalgamated company which are received by X, these are sold to a third party, that is not free from tax. That is not exempt from category of transfer. So tax will be levied. Now the question is, how will the tax be levied in this particular case? So the formula is sales consideration which Mr. X has received on selling, which Mr. A has received on selling the shares of Y Limited minus the cost of acquisition of shares of Y Limited. To put it very, very simplistically, I have put a formula over it. Okay, formula is sales consideration of shares of Y Limited. Y Limited 50 shares are sold. So whatever is received by A Limited by selling these shares, so sales consideration will be calculated as usual. Sales consideration is calculated as usual. There's no problem in sales consideration. Now the biggest problem is what will be the cost of acquisition, because X Limited has got the shares of Y Limited free of cost in exchange of X Limited's shares. Mr. A has got the shares of Y Limited free of cost in exchange of X Limited shares. So now the question is, what will be the cost of acquisition of 50 shares of Y Limited? That is the big question. And that is where this section comes into play. So this section says that cost of acquisition of Y Limited share will be equal to cost of acquisition of X Limited share. So yes, but obvious guys, when you get something in exchange of something else, then the thing that you have received, the value should be equivalent to the thing that you have exchanged for. So cost of acquisition of Y Limited share will be equal to cost of acquisition of X Limited share. Now to put it in perspective, guys, I'm putting some dates over here. So Mr. A had purchased the shares of X Limited in say 2004. Mr. X then, Mr. A then got these converted into shares of Y Limited in 2014. And finally, in the year 2022, Mr. A sold the shares of Y Limited. I have put 3 years in this particular chart to give you a perspective. Okay. Now, in 2022, when Y Limited shares are being sold, what will be the sales consideration? Sales consideration will be the usual sales consideration which Mr. A has received on selling the shares of Y Limited. Question number 2. What will be the cost of acquisition of shares of Y Limited? What will be the cost of acquisition, guys? The cost of acquisition will be cost of acquisition of these 100 shares which was acquired in 2004. Whatever is the cost of acquisition, that will be the cost of acquisition of Y Limited. Sorted, right? Sorted. Now, there are 2 more questions which are required to be answered. The questions are, what will be the period of holding of these shares? What will be the period of holding of these shares? That is the question which we need to answer. And guys, I'm changing this date a little bit, okay, to make it a little more interesting, okay. In 2014 itself, or maybe 2015. Okay, let's take it 2015. In 2015, the shares were sold by Mr. A, right? Now the question is, what is the period of holding of this particular share? Period of holding means for how much time did Mr. A held these shares, okay, of Y Limited. Now you have 2 options. You can tell me, sir, Y Limited shares were received in 2014. So the period of holding is almost 1 year or even less than 1 year. It is almost 1 year or less than 1 year, right? You can tell me that. Or you can tell me, sir, since Y Limited shares are in conversion of X Limited shares, therefore the period of holding should be determined from 2004 till 2015. Sir, why are we determining period of holding? The reason of determining period of holding is that we want to classify the shares between long-term capital assets or short-term capital assets. Because if we sell long-term capital assets, we will have long-term capital gain eligible for a lesser amount of tax rate. And if we sell short-term capital asset, it will be eligible for short-term capital gain. Therefore, we need to understand the period of holding. Two options. Number 1, Y Limited shares were acquired in 2014. So period of holding is only 1 year or even less than 1 year. X Limited shares were acquired in 2004. So period of holding should be 2004 to 2015. That should be the period of holding. So period of holding of X Limited should also be included in period of holding of Y Limited. There are 2 options. What does law say? Law says period of holding of Y Limited shares is equal to period of holding of Y Limited shares plus period of holding of X Limited shares. So both the benefits are to be given to the assessee. Period of holding of Y Limited shares, period of holding of X Limited shares. That is how we are going to compute. So yes, Sarneka is absolutely right. Bhavika is wrong. No, Bibu, not 2014. Right? So period of holding of Y Limited shares is equal to period of holding of Y Limited shares plus period of holding of X Limited shares. So period of holding will be computed from 2004 to 2015, which means long-term capital asset. And yes, we'll be eligible for indexation benefit also. Now the next question is one interesting one. You'll be fascinated with the next section. Now the next section is, sir, we have considered the period of holding from 2004 to 2015. The Income Tax Act has given a benefit of considering the period of holding of X Limited shares also in Y Limited shares. Now, sir, can we also get the benefit of indexation right from 2004? Can we get the benefit of indexation right from 2004, which will be a huge benefit? If we get the indexation benefit from 2004, it will be a huge benefit. If we get indexation benefit from 2014, it will be a lesser benefit. So we would always prefer a huge benefit which will be accruing to us if we get indexation benefit from 2004. But let's see, what does the section say? The section says indexation benefit is equal to from the year of acquisition of shares of the amalgamated company. So one benefit is already given to you in terms of period of holding. But guys, for indexation, we are not giving you the benefit from the date when X limited shares are purchased. Indexation benefit will be received from the date when amalgamated shares have been acquired. So indexation benefit will be a little less given to you. Period of holding will be taken from the year when the original assets were purchased, but indexation benefit will be given to you only from the year when the company got amalgamated, which means lesser indexation benefit. So more period of holding benefit, lesser indexation benefit. That is the ask of this particular section. But a very, very critical section, guys, a very, very important section from an exam standpoint also, and logical also. We are giving you certain benefit and we are withdrawing certain benefit. Hisab barabar. ठीक है, ठीक ठीक लगा लो भाई, हिसाब बराबर. We are giving you certain benefit. Period of holding we are giving you from 2004. Okay, indexation benefit we are giving you from 2014. Lesser indexation benefit is being granted to you. That is how the section is worded. Okay, sir. Next is the case of, okay, debentures getting converted into shares. So guys, when debentures get converted into shares, guys, let me get you back to the exclusions section. Okay, this is again the exclusion section. Okay, and in the exclusion section, from the definition of transfer, something was excluded. What was excluded? Conversion of bonds or into shares or debentures. Whenever you convert a bond or a debenture into share, right, that is free from capital gain tax. So this conversion is absolutely tax free. Okay, sir. So conversion is absolutely tax free. Subsequent sale is not tax free, and we are dealing with subsequent sale. Let me tell you how. All right. So these are debentures which you already have. They are converted into shares, and the conversion is tax free. Now the question is, when these shares will be transferred by you, will that also be tax free? Answer is no, that will not be tax free. The question is, when these shares will be transferred by you, will that be tax free? Answer is no, that will not be tax free. The first leg is tax free. Second leg is absolutely not tax free. Then again, same problem. Sales consideration is the consideration which you receive after selling these shares. Perfectly all right. But what will be the cost of acquisition? What will be the cost of acquisition? That is the question which we need to deliberate now. So cost of acquisition of shares is equal to cost of acquisition of debentures. So cost of acquisition of shares will be equal to cost of acquisition of shares plus cost of acquisition of cost of acquisition of debentures will be the cost of acquisition of shares. So yes, just like guys in case of in the last case also we had done, cost of acquisition of the shares in the amalgamating company was equal to the shares in the amalgamated company. Similarly, guys, cost of acquisition of shares in the cost of acquisition of shares will be equal to cost of acquisition of debentures, right? So cost of acquisition of shares is equal to cost of acquisition of debentures. Now the next question is holding period. What will be the period of holding? Okay, will it be only since when the shares are acquired, or will it be from the date when debentures are acquired? Okay, that is the question. Answer is very simple. Holding period is equal to holding period of shares plus holding period of debentures. Yes, both the holding periods will be combined together. Holding period of shares plus holding period of debentures, which means if you are getting a benefit of holding period, there might be a situation where your short-term capital gain will convert into long-term capital gain. That is the benefit which you might get if holding period is consolidated. This is not a fair point. Abhishek, fair. This is law. Okay. So this is what we have to accept. This is law. Everything cannot go in your favor, right? Something has to be dealt with in income taxes favor as well. All right. Next is indexation benefit. Indexation benefit will be given since the time the shares are acquired. Indexation benefit will be given since the time when shares are acquired. So when the acquisition of shares had happened, since that date indexation benefit will be given to you. Indexation benefit will not be given since the time debentures were acquired, just like in the earlier amalgamation case. Same case is there over here also. Some benefit is given to you, some benefit is withdrawn from you. This benefit is withdrawn, this benefit is given to you. That is the benefit, that is the provision of this particular section. Okay, sir, got it. And last topic of our today's class. Let me see. Amalgamation. Okay, rights issue. Yes. Last topic of our today's class, guys. Right? We'll be continuing the rest of the topics in the next class. ESOPs, employee stock option plan. First of all, I want to know, government का खजाना कैसे बढ़ेगा? Nalayak Jyotish, Nalayak comments. All right, guys. I want to know, in which chapter had I already taught you the treatment of ESOPs? In which chapter? Please write the name of the chapter in the chat box. And those who have not liked the video yet, please hit a like button on the video and do share this video with your friends. On the chat box, in which chapter did we study ESOP before? We have studied ESOPs before, employee stock option plan. In which particular chapter have we studied the concept of ESOPs before? Please write in the chat box. I want it in the chat box. In which chapter have we studied the concept of ESOPs before? In which chapter? Please write the name of the chapter. Oh yes, absolutely right. Jyotish is right, Mitali is right, Mansi right, Diptesh right, Kirti right, Pankaj is right, Bibhu is right. Perfect, guys. In salary, we had studied this particular concept called ESOPs. So ESOPs taxability is divided into two parts. Number one, salary taxability. Number two, capital gain taxability. How is it divided? That is what we are going to discuss now. Okay. Guys, as I had told you, ESOPs are options which are given to the employees for purchasing the shares of the company at a concessional rate. Now, there is a grant date when the option is given to the employee. So, suppose I'll put in figures over here. Okay. Suppose assets of the company are being traded at 120. On the grant date, the employee will be offered the share at 80 rupees. Okay. The value of the asset, the value of the share, which is there in the market, as on the grant date, it is 120. Okay. Grant date means the option is granted to the assessee, to the employee. Option is granted. Whether employee will accept it or reject it, it's a later matter altogether. It's a different matter altogether. This is the grant date when the option is granted to the employee. He will be given time to think, okay, and then on the exercise date, he will be asked to exercise his option, whether he wants to take it or whether he wants to reject it. Okay. So on the grant date, option will be given to the employee that, today's market price of the share is 120. We are offering you this share at 80 rupees. Please think through it, whether you want to take these shares, ESOPs of the company or not. Then what is the exercise date? Guys, exercise date means the date on which this option is to be mandatorily fixed by the employee. Employee has to say a yes or a no to the offer, right? So on the exercise date, suppose the exercise date is 1 year hence, okay? And yes, there's a lot of gap between grant date and exercise date. So on the exercise date, the value of the share is 150 and this share is still available at 80 rupees to the employee. Employee said that, okay, you give us 80 rupees and this share will be given to you, right? It's a benefit which is extended to the employee. Otherwise, this share is costing us 150 rupees, right? So this is the exercise date. Now, on this date, the employee will either accept the option or reject the option. If he rejects the option, then taxability will not arise. There's no taxability if he rejects the option. But if he avails the option, please note, if he avails the option, then he is subject to taxation. Guys, this is perquisite in hands of the employee. This 70 rupees is the perquisite in hands of the employee. Employee is getting a thing which is worth 150 at 80 rupees at the cost of the employer. This is nothing but perquisite in hands of the employee. So salary is equal to, salary means perquisite. This is perquisite. Perquisite is equal to fair market value on the exercise date. On the exercise date, whatever is the fair market value minus price paid by the employee. The difference between these two will be perquisite in hands of the employee. So yes, over here, the salary taxability ends. Now, what is triggered? Capital gain taxability. Now, after 2 years, the employee decides to sell off these shares. The employee decides to sell off these shares, and these shares were sold by the employee to a third party at 200 per share. The shares are sold by the employee to a third party at 200 per share. Guys, in this particular case, there will be a capital gain which will accrue on sale of these shares to a third party by the employee. What will be the capital gain? The capital gain will be sales consideration minus the FMV on the exercise date. So whatever was the FMV on the exercise date, you have already paid taxes on that FMV. The difference between these two, 50 rupees, will be the capital gain. To sum it up, in a nutshell, the benefit which assessee derived from these shares is 200 minus 80. The total benefit which the assessee derived from these shares is 200, which he received as the sale consideration, minus 80, which he had to pay to the company. Okay, this is the total benefit. Total benefit is 120 rupees. Okay, now 120 rupees is divided into two parts. Number one, 70. Number two, 50. 70 is offered to tax as salary, and 50 is offered to tax as capital gain. In a nutshell, this computation will tell you how the income which has accrued in hands of the employee is taxable, right? So the total income which accrues in hands of the employee, which is 80 minus 200, which is 120, is bifurcated into two heads. One is salary, perquisites. Second is capital gains. That is how the income is distributed. So yes, if a question comes from salary chapter of ESOPs, then this part of the computation is relevant. And if a question comes capital gain of this particular chapter, then this part of the computation is relevant. If a question comes where both of these computations are asked you from the in the examination, then both of these are relevant for you. So yes, this was the capital gain taxability of ESOPs, employee stock option plan. Employees are given option to take the shares of the company at a very, very considerable, at a very, very reasonable price, and the benefit which accrues to the employee is divided into perquisites as well as capital gains. These are the two heads in which the profit will be split. So yes, guys, that's all for this particular session. And let me ask all of you, how's the Josh in the room? Please write in the chat box. How's the Josh? Are we feeling more confident in tough chapters like PGBP and salary after this revision series? Are you guys feeling more confident? Please write in the chat box if you're feeling more confident after the revision series. How's the Josh? Please write in the chat box. Pankaj says, hi, sir. Bibu says, hi, sir. Yes, yes, guys, the Josh is high. And I'm very, very sure that you are going to immensely be benefited by these small, small videos which I am making, and I'm discussing them with you. Guys, please be with me before this live sessions. Do watch the videos which are there with you so that your concepts are more concrete after watching these video sessions. And yes, this PDF of this slide deck I'll be sharing with you on the WhatsApp group. So be live on the WhatsApp group. I'll be sharing PDF over there. So till this particular section, till this particular part in your study mat, the test will be asked in the coming Sunday, 7 p.m. So till ESOPs, your test will be scheduled on the Sunday, 7 p.m. So be prepared for the test. PDF of this particular slide deck will be shared with you in the WhatsApp group, and we'll be meeting in a subsequent session. The next session is on Tuesday, 9 a.m. Before that, we'll be meeting for our test at 7 p.m. Before we sign off, all the very best. Let's meet on Tuesday, 9 a.m. and Sunday and 7 p.m. All the very best and happy studying. Bye-bye. See you on Tuesday.